Hello, everybody. This is Robert Salisbury, your licensed associate real estate broker with Keller Williams. And today, hey, do you guys want to know? Do you want to know how the bank figures out your mortgage payment? Well, guess what? I'm going to show you how that happens. I'm going to break this up into two videos because I want you guys to understand the concept of how the bank figure out how they come up with the payment. So, with that being said, the first thing I want to go over is, as you guys know, I am a licensed real estate professional. However, my previous life, I was a mortgage broker, and I also was a banker for many years as well. So I'm very familiar with the process of how the bank determines your mortgage payment. So it's a couple things that goes into play. It's about 5 or 6 different things that really matters what the banks is going to be looking at. The first thing they're going to be looking at is your debt. They're going to be looking at the income that you're going to be bringing in. They're going to be looking at your credit, of course. They're going to be looking at the type of mortgage that you're going to be getting. They're going to look at your taxes and insurance. And if you're going to be getting a co-op or condo, the maintenance, the common charges are going to play. And for some of these houses that you guys are buying in these communities, the home association fee as well is going to play a part into that. So here's the first thing that the bank is going to be looking at. What they're going to do is they're going to look at your debt and your income, and they look at what they call the debt to income ratio. So basically, what they're doing is they're going to take your debt and they're going to divide it by how much income that you're going to be bringing in. So as far as debt, what they're gonna do is they're gonna pull your credit report, and they're gonna look at every open line of credit that you have. They're gonna look at all the minimum payments for each thing that you have open. So if you got a car loan, they're gonna look at that minimum payment. Your student loans, if you have that, your credit cards. A lot of times credit cards have minimum payments of like $25, $30, or whatever loan that you might have. They're only gonna look at the minimum payment for each open line of credit that you have. Now, they're not going to include like your rent, because your rent doesn't show up on your credit report, or like a utility bill, a cable bill. That kind of stuff doesn't show up on your credit report. So they're going to look at everything that's on your credit report, number one. Number two, they're going to look at your income. They're going to look at your income before taxes. They're not looking at what you technically bringing home. They're looking at what you make before taxes. So, prime example, if you made $60,000 a year, what they're gonna do is they're gonna divide that by 12 for you people that's a little bit math inclined. And if you divide 60,000 from 12, that's like $5,000 a month. So they'll look at that number as far as your income is concerned. And of course, if you're married, or if it's a couple, they're just gonna combine everything and add it together. So they're going to look at what they call debt to income ratio. And what debt to income ratio is basically saying is how much debt that you have that's covering your income. And the bank is going to give you a certain amount of debt that they're going to allow you to have based off the income that you're going to be bringing in. So I'm going to give you an easy example just to show you how this works. So let's just say you pull your credit report, and let's say you got a car loan for $500, which is very doable. $500. Let's say you have student loans for $300 a month, and then let's just say you have like 4 credit cards. That's $25 a pop. So we'll say it's $200 worth of credit card debt. So that's about $1,000 worth of minimum payments that you have on your credit report. And they're gonna take your income. So we're gonna use 72,000 to make this easy. So if you divide 72,000 from 12, that puts you at 6,000 a month as far as income before taxes. So they're gonna take the debt and they're gonna divide it by the income. So if you do $1,000 and you divide it by 6,000, that's gonna put you at about 16.66%. So that's saying that you got 16% of your debt is covering as part of your income. So with that being said, you want to hold back a minute and just remember that number, that's 16%. So it's going to really depend on the type of mortgage you have, because every type of mortgage has a different types of DTI, or debt to income ratios. So there's different types of mortgages. There's FHA mortgages, which you guys have heard of probably. There's a conventional mortgage. There's a VA loan that you could get. There's different types. And different types have different amounts of debt that they'll allow you to have, or debt to income ratios they'll allow you to have. So like a FHA mortgage could be like around 55% or somewhere in the ballpark. VA loans is something in that area. A conventional mortgage may be a little bit lower, maybe like in the 30s or 40%. So for this example, I'm just going to use 40% because it's really going to depend on what type of mortgage you're going to have. So we're going to use 40%. So let's just say the mortgage you're going to have is going to allow you 40% debt to income ratio, and we calculated that 16% as what you have now. So what you do is you subtract that 40% from the 16% that's your personal debt to income ratio, and you come up with like 24% basically. So the bank is going to allow you an extra 24% of debt based off your income to figure out your payment, if that makes any sense to you guys. So the way you figure out your payment is you take that 24% and you multiply that by your income. So in this example that we're using, is, as I said earlier, we were using $6,000 a month as your income. So if you multiply 6,000 from 24%, for you people that's a little bit mathematically challenged, 6,000 times 0.24, and then you'll come up with $1,440. So the bank would allow you to get a payment up to $1,440 based off of a 40% debt to income ratio. Now, remember what I said earlier. Some of them can be more than 40%. Like FHA might be in the 50s. They may allow a little bit more. But for the most part, like I said earlier, we're using 40%. So as I said earlier, I'm going to break this up into 2 videos. But that's the first part, to figure out how much payment they'll allow you to have. The second part of my video, I'm going to get a little bit into credit. And then I'm gonna get into what that $1,440 consists of, because that's gonna be important, and also the interest rate is gonna be important as well, because that's gonna determine your payment. So the lower the interest rate, the lower the payment, basically. So I really hope that I'm helping somebody today, because I know you guys don't understand. Some of you guys just go to the bank or whatever, and then they just tell you, hey, you're pre-approved for this amount, etc. But I want to help you guys think intelligent about this, and and if you need to maybe pay out some debt or something like that, or if you need to make more money, or if you need to get a bigger down payment, just to kind of give you an idea of the spectrum of what you can afford and what you need to do. So listen, I'm hoping I'm helping somebody. Once again, my name is Robert Salisbury. I'm with Keller Williams. If you want to give me a call, my number is 646-470-2787. You guys can also DM me if you like. If you want to text me, that's fine. If you want to private message me, that's okay. But listen, guys, I hope you guys have a nice day. And please share my video if this will help somebody. Thank you, guys.